Good morning and welcome to the Travelex weekly briefing for April 25th, 2011. The market last week became transfixed on three major developments as it approached the Good Friday weekend. These issues were the Standard & Poor's downgrade warning to the U.S., the diverging market outlooks on central bank interest rate differentials, and the robust earnings report from bellwether firms globally. The amalgamation of these developments sent equities and commodities higher, all at the expense of the U.S. dollar. Standard & Poor's announcement last week to downgrade the U.S. credit outlook from stable to negative sent a series of shockwaves through the fabric of the financial markets. The world's top rating agency felt strongly that the lack of cooperation between America's two major political parties was creating a material risk to the management of its national debt. The U.S. Treasury rate is widely regarded as a risk-free rate, and the possibility of credit risk existing within such a financial product dramatically debased investors' confidence in the U.S. debt, and in turn sent excessive demand to U.S. gold prices and sent gold prices to a historical high. The second major effect helping to sculpt the global financial markets were interest rate differentials or monetary policies of central banks globally. First, for example, the Federal Reserve has repeatedly asserted that inflation remains well within their comfort zone, and the spare capacity within the U.S. market should be able to offset any sort of exogenous impact. However, this is highly contrary to the perspective of other central banks, such as the European Central Bank, which believes that inflation is an imminent concern. In fact, the European Central Bank earlier this month raised interest rates by 25 basis points to counter this inflationary threat. In turn, investors seeking greater return on their investments trimmed their positions in lower yielding investments such as the US dollar in favor of higher yielding investments such as the euro. Finally, last week's earnings reports from a series of firms and their consequential rally in the equities markets made the flux from lower yielding currencies to higher yielding currencies that much more acute. The combination of these developments sent the US dollar tumbling. It fell to a 16-month low against the euro, a multi-year low against the Canadian dollar, and historic lows against the Swiss franc and the Australian dollar. Looking ahead, this week features several prominent economic reports that will help to shape the future of the global economy. These include the U.S. Case-Shiller Home Price Index coming out on Tuesday, and several GDP reports, including those from the UK, the U.S., and Canada. The Federal Reserve's Federal Open Market Committee meeting is expected to meet on Wednesday to decide on their most recent stance for the Federal Reserve on monetary policy. Investors do not expect a change in the Fed's interest rate policy, though some investors do believe that there may be a slight possibility of them ending the Federal Reserve's quantitative easing program. For this and more information, please feel free to check us out at Travelex.com.